So let's get chatting and focus zero in on the EMS space. Now, it's been a big wealth creator. Dixon listed, for the last 5 years, Dixon's revenue growth has been about 40 to 45%. Kaynes has had a shorter listing history. It listed only in 2022, but in the last 3 years, Kaynes' revenue growth was about 62% CAGR and the profit growth was about 165%. What does the future hold? Investec recently turned positive on EMS stocks. They're convinced about the growth opportunity in the sector. They upgraded Kaynes Tech and Syrma SGS. They also prefer Dixon Tech and Amber Enterprises. So to discuss this sector in detail, we'll connect with Saurabh Gupta, CFO of Dixon Technologies, and Jairam Sampath, whole-time director, CFO of Kaynes Technology, on the show now. Thank you very much, gentlemen, for joining in. That's the first question, right? The kind of exceptional growth that we've seen in the past for this sector, can it continue over the next 3 to 5 years? And I want both of you to weigh in. So, Saurabh, you start first. I was just checking. Your 5-year revenue and profit CAGR was 40 to 45%. Your ROEs were about 23, 24, 25%. Now, considering that you have expansion plans, you're adding capacity, you're looking at display fab manufacturing for the next 3 years at least, do you think you can sustain this 40, 45% kind of revenue profit growth and maintain your ROEs?
Yeah, good morning. Thank you for having me. So we feel confident that kind of opportunity that we are sitting on, both for the domestic market and now increasingly for the global markets as well. I think so there is no reason why we can't grow by 35 to 40% annually for the next 3 years with more focus on backward integration. So I feel that that will add more strength and moat, and that should also lead to the margin expansion that what we are doing right now. So yeah, 35 to 40% of the growth is definitely doable for the next 3 to 4 years.
And ROEs, can you build on the ROEs from current levels, or do you think the expansion could hurt?
My sense is we have grown from 2,000 odd crores to 39,000 crores, hopefully this financial year. And we have not compromised on the ROCs and ROEs. In fact, those have only gotten better. So like last quarter reported ROC for us was almost 42%. And the initial years we were at 30% kind of ROC. We think that those ROCs and ROEs profile should be maintained. There should be significant cash flow generation, because the businesses where the largest growth for us is happening is basically mobiles and maybe IT hardware going forward. So all these businesses are high on asset turns. And once you focus more on the backward integration, those again will have a positive impact on my ROCs and ROEs.
Jairam, you come in on the next 3-year picture. Now, you're setting up capacities in PCB, OSAT over the next 2 to 3 years. So that's going to be the incremental revenue driver. What kind of a revenue growth are you confident about for the next 3 years, given the visibility and the plans that you have? And throw in your expectation on how margins and the return ratios move.
Yeah, so thank you for having me on the show. I think these questions have been something that we've been battling with ourselves. See, fundamentally, the EMS sector, or ESDM sector, as we would like to call it, is good for maybe around 40 to 50% CAGR without any dilution of our EBITDA numbers. Of course, we need to improve our ROC a tad by improvement of working capital, net working capital, which perhaps will happen with the scale too. Now, the additional sectors that we have forayed into, like the semiconductor assembly and the PC board, is going to be value accretive. And so by maybe about 2-3 years time frame, they will also start weighing in with their revenues and profitabilities, etc. So I think we should be able to see about 40 to 50% CAGR on revenues for sure, without any dilution of margins. And hopefully we would probably also improve the performance of our working capital management so that the ROCs, etc., can be maintained. It's important to say that one thing is to enjoy the tailwind that's already available. The other thing is to also prepare for the future, because we are now looking at beyond FY28. 28 is when we said we'll get to $1 billion. It's a big number for us. And maybe beyond that, we are acutely aware of the fact that within a couple of years, again, it has to get into a higher number. So we are also looking at other beachheads, so to say, to bolster this market. So currently, it's obviously domestic driven with a lot of tailwinds and government's stated position of Atmanirbhar Bharat and all that. But over time, I think all of these things are bound to see some corrections. And so we are preparing for a future wherein the geopolitical let's say, items also come into the agenda, and then we don't want to be taken by surprise. So we are also looking at other beachheads and so on, so that we can maintain this growth of 50% plus CAGR over next 10-year time frame.
Okay, all right. Mr. Jairam, welcome to the show, and Saurabh, welcome to the show as well. Mr. Jairam, let me come across to you first. The longer-term story seems to be intact, but tell us, how do you see ordering activity in Q4 so far? And also, if you could tell us about the ordering activity for smart meters. Give us a sense about it. Is it good enough? Is it up to expectations? Has there been some slowdown? Ordering activity, I want to get a sense of pulse on ground.
Yeah, sure. So let me take the second one, the smart meter bit. I think what we see is an acceleration. So this year we might end up with a very good fourth quarter thanks to the smart meters. And next year we'll probably double the number of smart meters that we deliver. So from the perspective of order inflow, that's always been increasing, and the order inflow has been increasing at almost 25 to 30% per quarter on a quarterly basis. So you multiply that by 4. So it's a pretty strong input of orders. And this is after, not really getting the kind of orders that we actually were expecting in some of the sectors that we are very strong in. So I think FY26 story will be probably even better than FY25. So we can see, in some sense, we've seen the bottoming out of the, let's say, the growth story. And then I think it's there to pick up. Lots of good things have happened, not just in our ESDM market, but also in our semiconductor and PC board also. The nearer we get to it, we certainly realize that we should have probably done it earlier. So I think the overall, the order inflow, business outlook, all that is extremely good, and it is probably better than what we expected.
What on the PCB project, what is the incentive amount that you're factoring in? And if you could tell us, when does that project go on stream as well?
Yeah, that project goes on stream we'll start getting significant revenue the fourth quarter of coming year, FY26. And we get about 60% total capital subsidies. We don't talk too much about PLIs, etc., because PLIs are visible things, and we don't give much reliance to PLIs. But certainly, capital subsidy is something which helps us to get off the ground very quickly.
Okay. Since we're on company-specific issues, let me just wind that up before I talk about the other global issues. Mr. Sampath, so this delayed orders, I mean, Q3 was impacted by this 100 crore delay, which was supposed to be pushed over in Q4. Are you on track with that? And I think at the end of the third quarter, you said that the year should end between 2,800 to 3,000. Are you still within that ballpark for the revenue?
Yeah, we'll certainly cross 2,800, and we'll do the EBITDA of 15%. We are hardly a few weeks away from the end of the year, so I think that is on track. And coming year, certainly we are a little more careful. Most of the delivery-related issues have been ironed out, and now most of the factories are firing on all cylinders. So hopefully next year will be a little easier. And
and just very quickly, okay, got that. So this year you should be within the ballpark of 3,000, which was your earlier guidance. Got that. And just very quickly, Mr. Sampath, there was some talk of you looking at equity fundraising as well. There was a talk of a 1,600 crore rupee fundraise because you wanted to acquire maybe entities overseas. Where are you on that?
Yeah, so we continue with our actions. So only thing is the fundraise probably got deferred by a couple of months. We thought we'll get the year behind us before we got the approval from the shareholders. So we'll be launching sometime in the coming fiscal. When the time is right and the opportunity window is there. At the same time, we are not diluting on our activities, and we do have a 3-pronged strategy. One is geography expansion, the other is getting better strength into the ODM area, and also deepening technology footprint. Because we do realize that all these tailwinds of demand, which is crafted by, let's say, either by tariff barriers or by any other localized demand factors, over time will get equalized, and then we need to be a technology leader. So that's what we are preparing for. This is not required for our $1 billion target, but it's required for doing something beyond 1 billion come FY28.
So basically that fundraise has been pushed by maybe a couple of months. Got that. Now let me come to Saurabh. And now the bigger question that we wanted some understanding on. I was looking at a note that's come in just yesterday. It's a Nomura note, because everybody's trying to wrap their head around the numbers on this whole tariff business, right? So we are obviously importing a lot of the components and duties. India's duties on components have been going down. in line with the government's Make in India push, right? All of you have been sort of asking for it, and the government has been doing that. According to these estimates, these are Nomura estimates, our overall electronics exports to the US have grown big time. I mean, they were at 2.5% in FY20, and they're at $11 billion in FY24. So now, if reciprocal tariffs kick in, what happens to the EMS story with respect to the US market? If you could give us some ballpark sense on that and whether it impacts you in any way. I mean, over the weekend, we had Mr. Howard Lutnick. He was all guns blazing, saying, make those, Apple phones in US. Why should they be made in China? He didn't take India's name, but we know those phones are being made in India as well, right? And he was saying that even if the wages are higher, get robots to make them, but make them in America. So with this kind of a mindset, Saurabh, if you could take this up, I mean, isn't this a straight worry for your business?
Yeah, so let me share you my perspective. Of course, yeah, so this is an ongoing thing. The negotiations are going on, as you mentioned. The broad counters are still not out. There has been more still in the discussion phase. But let me give you my perspective. One, of course, India's export to US is $11 billion, and this number will, of course, go up in FY25 as well. But it is still much lower than what China exports. So China's exports, so India's share of electronic exports to US is just 2 to 3%. China is broadly at around 35%. Mexico is somewhere around 22%. So clearly they're very higher as far as the US imports of electronic products are concerned. Now on both the countries, the tariffs have been implemented, and to the extent of almost 20%, which was negligible or nothing in the past years. So we feel that India is at a competitive advantage. So overall, we feel that it will be beneficial for India, because if you look at the overall import duty of on any finished product of mobile phones, it's still 15%, and on wearables, it's around say 20% odd. But if you look at the overall components as well, components are slightly lower. So the weighted average tariff is still 3 to 4% for electronic products, which is still very low. So now, assuming the Trump is talking about reciprocal tariffs, so either you can put the same tariff on the same product, or you can put a weighted average tariff across a basket of commodities. Now, the basket can be on export and import can be different. So according to that, if that comes into the system, we are talking about 3 to 4% tariffs, which is very low. Now, as far as your question on the manufacturing in US is concerned, we feel that is slightly difficult. Of course, anything can happen, but we feel one, because of the low value addition of the product. Secondly, the wage rate differential disparity between both the countries. So US is almost 10 times more expensive. So we are talking about $1.5 an hour versus $15 in US. Third, the US dollar is strengthening, making the manufacturing more expensive. So we feel that seeing in light of all these factors, India is slightly in a better position. But of course, these things also, we are living in a dynamic world. So this tariffs needs to be sustained on China and Mexico for the supply chain to shift.
No, Saurabh, sorry, just trying to come in to understand right now, what is Dixon's exposure to the US, if at all? Total revenue, what is the export element to the US, if at all? And then if Mr. Sampath could tell us the same. Saurabh?
So for us, it's a very small number. Last year, it was out of, it will be broadly 5% of my revenues, mainly for my anchor customer. But the same anchor customer is now talking to us for larger export quantities to US in light of the tariffs which have already been levied to our neighboring country, on our neighboring country.
And you don't think that's at risk? Will that anchor customer, US anchor customer, continue to look at sourcing large volumes given, the sort of the rhetoric and the reality in the US on tariffs?
So my sense is we feel that we will be at a competitive advantage as compared to China, even after this reciprocal tariffs come into the system, which will not have much of impact as what we think. As far as electronic products are concerned and smartphones are concerned.
Saurabh, Jairam, great conversation. More to ask, but we're out of time. But thank you very much for joining in on this discussion on tariffs, the long-term picture, the near-term, and so much more. Get into